Hello, everyone. My name is Blake Otilling, and I am an internal wholesaler here at OneAmerica for our Care Solutions, Asset-Based Life, and Annuity Long-Term Care Solutions. Today's deep dive will focus on why long-term care benefits, and in particular lifetime long-term care benefits, are so important and debunking the myth of solving for the average claim for long-term care. Now, you should be able to download a copy of the slides from the GoToWebinar panel on your screen. If you do have any issues, please feel free to reach out to us at caresolutionstraining@OneAmerica.com. Also, please feel free to enter chat questions during today's presentation. While we won't be able to handle those questions during today's presentation, we will reach out to you after the presentation to make sure that all your questions got answered. Now, before we get into comparing different types of LTC benefit pools, let's talk about the risk. So right now, the average cost of care nationally is about $105,852 per year for a private room in an LTC facility. Obviously, it's a little less in some parts of the U.S. and more in others, but I'll just use this average for now as an example as we walk through it. Now, we know medical costs have gone up over the years, and typically it's somewhere between 4 to 6% range. So for the sake of our example, we'll assume a flat conservative 3.5% inflation rate. If I do that over the next 10 years, what we get is a one-year stay in a private room grows to $149,315 per year. And in 20 years, it will grow to just over $210,000 per year. Now, obviously, there's a lot of trends that will impact the cost of care going forward. The first is higher demand. There are 10,000 baby boomers turning 70 years old every day. Most of these baby boomers are fine right now health-wise, so we don't expect this to hit baby boomers for another 10 to 15 years. But when it does, simple supply and demand tells us that the cost of care is going to go up because of it. Another issue is that by the year 2035, for the first time in U.S. history, older generations are projected to outnumber children, according to U.S. Census data. And that raises the question of who's going to take care of this aging population. The second trend is longer lifespans. The medical community is making huge strides in making us live longer, but unfortunately, they really haven't been making any advances in preventing or curing Alzheimer's or some other form of dementia. And those types of illnesses will require longer periods of care. I've even seen projections that millennials could have an average lifespan of up to 110 years old. So our bodies are living longer, but our brains can't keep up with that. Thus, we're going to continue to see the average long-term care claim go up in both duration and cost. The third trend, and one I'm sure that a lot of you have seen, is family dynamics. Now, it used to be that adult children would stay close to home, but now children leave home and move hours away, sometimes even states away. With adult children living further away, there's going to be less informal care being given by adult children and a much heavier reliance on formal caregiving being done by home health care agencies and long-term care facilities. The fourth trend here is the government. Now, no matter how you feel about the government, we can all agree on one thing. It's always changing. And when we talk about the government, when we talk about long-term care, we're talking about Medicaid. Well, Medicaid, just like the government, is always changing. And no one can say what its rules and qualifications will look like in 5 years, let alone 20 years from now. Right now, most states' biggest expense is Medicaid. So just like you with your household budget, states will look at their biggest expense first as a way to cut costs. So what's going to be available and who will qualify for Medicaid 15 or 20 years from now really becomes a difficult thing to judge. We've already seen look-back periods extend from 3 years to 5 years. We've also heard talks of extending it to 10 or more years. We've seen states like Minnesota creating think tanks on how to cut Medicaid long-term care spending. We've seen the addition of filial laws for a lot of states. For those of you not familiar with filial laws, here's how it's spelled. F-I-L-I-A-L. Now, while filial does a lot of things, it really does one thing for Medicaid that we all need to be aware of. It allows states to go after children for the cost of care provided to a parent by Medicaid. So all of these things are just the beginning of the states trying to cut the expense of Medicaid down. So now let's take a look at the average per year cost of care we projected out starting 20 years from now, just over $210,000 per year, and see what it would look like over the average length of care. So according to Medicaid, the average length of care is 2.2 years for men and 3.7 years for women. Now, keep in mind, this is just for care in a long-term care facility and does not account for home health care, because Medicaid typically does not pay for home health care, barring some exceptions there. But I want to use these numbers right now for our example, since it's the numbers you hear thrown around a lot in the LTC industry. Putting it all together, if we use this average annual cost of care and the average length of care, what it does is it would make the average LTC cost for men would be $463,371. And for women, it would be $779,305. Now, if we consider the average Alzheimer's claim of 8 years, that would be an LTC need of over $1.6 million. Obviously, all of these numbers here on the screen are averages, but we have to remind ourselves, what does average truly mean? No pun intended. To really drive this point home, I'm going to use the average NFL career length. The average NFL career, according to the average, would end with about 4 minutes to go in the fourth quarter, in the fourth game of the fourth season of a player's career. Now, ask yourself, how many players does that actually happen to? The answer is almost none. There are players that play 20 years in the NFL, and there are players that play one game in their entire career. Realistically, the same thing would apply to the averages here on the screen. This will happen to almost no one. Some people will never have a single day of long-term care, and some will have 16 plus years of care. As a matter of fact, we have a policyholder in 2020 here at OneAmerica who went into her 16th year of claim with us. Now imagine if she had planned on the average with an LTC policy that only lasted her for 4 years. She would have spent the last 12 years exhausting her entire legacy, eating up the assets for her spouse's retirement income, and probably would be in a Medicaid bed, letting the government dictate the quality of care for her. Now, these are just all examples of why we shouldn't plan for the average when it comes to insurance. And if you think about it, the long-term care insurance industry is the only one where we see a lot of people planning for the average claim. In every other insurance industry, people sell for the catastrophic. What I mean by that is this: we must protect ourselves from a total loss of our home in a fire and make sure that our medical insurance covers cancer treatments. And yet, I've yet to hear a wealthy person tell their medical insurance carrier, please give me a smaller risk. Hey, I don't need to cover cancer. Wealthy people can cover a 1 or 2 year type of need for claim, but you wouldn't want to self-fund an Alzheimer's claim of over $1.6 million like we projected out earlier. And remember, that was just an average Alzheimer's claim, let alone a catastrophic 16 plus year type of need that we also talked about. So why is long-term care being treated differently by so many people? Well, if we're honest with ourselves, it's because we've kind of allowed ourselves to be brainwashed by long-term care insurance carriers that we need to sell for the average, because that's all that most of them are willing to sell us policy-wise. So we've got to retrain our minds to protect our clients against that catastrophic risk. Because remember, that's why insurance companies and policies exist, is to remove the catastrophic risk off the individual. So I mentioned here at OneAmerica that we had a client go into her 16th year of claim with us in 2020. As you'll be able to see on this slide, we're not alone. Based on a January 2019 American Association for Long-Term Care Insurance survey of leading long-term care insurers, here are the longest claims that are still open at 7 top long-term care insurance carriers. Looking across the numbers quickly, you'll see 14 years, 19 years, 16 years, 15 years, and so on. Unfortunately, in that survey, it also determined that 13.5% of claims ended due to benefits being exhausted. This goes to show that solving for the average long-term care need can be devastating to families. Not everyone will be average, nor can we guess who will be. Also, these numbers help illustrate even men can have catastrophic long-term care claims. If you look at most companies, men are currently the longest claims they have going. So this helps illustrate that longevity isn't just a female risk issue. Because this right here is our biggest concern. Right now, about 5.6 million Americans aged 65 and over have Alzheimer's, which is about 1 in every 10 people aged 65 and over, and more are being diagnosed every 33 seconds. And we expect this number to more than double by the year 2050. Another stat that's not shown on this slide is that 1 out of every 3 people over the age of 65 dies with Alzheimer's or some other form of dementia, and that's according to the Alzheimer's Association. So all of these numbers will escalate in the coming years as the baby boom generation continues to age past 65, when the risk of developing Alzheimer's disease is the highest. So all of this leads us to the conclusion that we've got this perfect storm brewing in this country for a dramatic increase in long-term care cost and need. So obviously there's a lot of statistics out there in the LTC industry, and I've already thrown a lot of them at you. The most popular one I'm sure that most of you have probably seen before, is that 70% of people over age 65 will require at least some type of long-term care service during their lifetime. And 20% will require long-term care for more than 5 years. Now, if you bear with me, I'd like to share with you a quick story I was told by one of our wholesalers. This wholesaler was meeting with an advisor who said he was struggling with offering lifetime benefits. I'm going to retell her story to me in her own words, and I'm beginning the story now from the wholesaler's point of view. So we were at a client event, and the clients began to fill the room. I was at the front of the room preparing the equipment for the presentation. The advisor walked up and said, "Please, help me understand why someone will want lifetime benefits. Isn't it like 1% that will actually need it?" I responded, "No, it's quite a bit more than that. Let's use this group of people to paint the picture. There are 20 clients here today. We know that 20% will need care for longer than 5 years, and many will need care due to Alzheimer's, which has an average length of care of 8 years. That means 4 of these will need a lifetime benefit option. So go ahead and pick out which 4 will need a lifetime benefit option." The advisor smirked a little bit, knowing that he wouldn't be able to tell me who will need it. I went on further to explain. You see, if you helped all these people plan for the average, then you would have single-handedly ruined 4 families' lives. Everything they worked to build, retirement for their surviving spouse, a legacy for their children, all potentially completely devastated, along with their plan and their family. If all 20 plan for the lifetime option, you can know with almost certainty that all the planning will still be intact for however long they need care. Besides, if you polled every client in this room and asked them, "Do you want income for 3 years or for the rest of your life?" they will undoubtedly tell you, "For my lifetime." So that's the end of her story. And I like this story because it paints a good picture, in my opinion, of why we need to be solving for the catastrophic. I would never want one of my clients to feel the pain of their LTC plan falling short. So if you recall from a previous slide, the average length of care for Alzheimer's is 8 years. On this slide, let's take a look at what might happen if a client had $12,000 per month claim and a $12,000 per month LTC benefit. We'll look at this through 3 scenarios. If the client had a 4-year traditional LTC policy, a 6-year hybrid LTC policy, or a lifetime benefit option with OneAmerica. So as you can see in this scenario, the client would be completely covered with lifetime benefits. However, the client would fall $288,000 short with a 6-year policy. With a 4-year policy, the client would fall even shorter and be required to pay $576,000 out of pocket. Remember, these are just numbers using an average Alzheimer's claim, not a catastrophic one. Now, as I mentioned earlier, OneAmerica had a client go into her 16th year of claim with us in 2020. Here's a look at that same scenario from the previous slide if that client had a 16-year claim. Again, with lifetime benefits, the client would be out of pocket nothing. With a 6-year policy, the client would be almost $1.4 million out of pocket. And with a 4-year policy, the client would be almost $1.7 million out of pocket. Remember, these 4- and 6-year policies would be covered for more than the average claim for an individual. But did that matter for this client? It doesn't. Now, while we compete against the misconception of solving for the average with regards to LTC protection, that's not our biggest competitor. The biggest competitor is actually affluent clients thinking that they have enough to self-insure or self-fund. Even for the affluent or mass affluent, you want insurance. Because no matter how healthy you are, you still have health insurance. And that's because you wouldn't want to self-insure the risk of getting cancer. You'd still want to put that catastrophic risk of paying for cancer treatments on an insurance company, even if you could afford it otherwise. I've yet to hear a person ask their health insurance carrier what the average claim is on a health policy to determine what kind of coverage to purchase. The same thing should really apply to long-term care. Affluent people can self-fund a 1 or 2 year claim, but you wouldn't want to self-fund an Alzheimer's claim of $1.5 million like we projected out earlier. And remember, that was just the average Alzheimer's claim, let alone the catastrophic 16-plus year type of need. Another thing to consider for clients that plan on self-funding is how that affects their retirement. When you self-fund, you're spending your assets for long-term care. And what clients forget is that assets in retirement are what you use to create retirement income. So if you're spending assets, you're lessening your retirement income. And you're doing it at a time when your expenses are at their highest due to long-term care costs. To help paint this picture, let's meet John and Carmen. John and Carmen are married and never bought LTC insurance and subconsciously decided to self-fund the risk of a long-term care event. Now, the two of them have $2 million in assets driving their retirement income. They do a 4% withdrawal off of the assets each year, living off of an income stream of $80,000 per year. Now, let's imagine that Carmen has developed Alzheimer's and they spend $1.5 million for her care. Now, they only have $500,000 left in assets to drive their retirement income. What does that do to their income stream? Well, if they continue doing a 4% withdrawal per year from assets to live on, their income just dropped 75% and plummeted from $80,000 per year in income to $20,000 per year in income due to only having $500,000 left to provide that income stream. At the end of the day, yes, they had the assets to cover the risk. But in reality, John and Carmen couldn't afford to self-fund because now they've blown up their entire retirement income. So the real issue here is that long-term care is not an asset issue. It's an income issue. Self-funding doesn't prevent that loss in income. In fact, it can perpetuate it. The number one thing that can absolutely blow up a retirement plan is a catastrophic long-term care event. So we've got to take that risk off the table for clients. And the only way to do that is with an LTC benefit income stream that lasts a lifetime. The same issue could arise if clients had an LTC plan that only covered 4 or 6 years and then fell short. So we talked about the income stream issue that could be caused by spending down the assets to cover a shortfall from an LTC plan. Now let's talk about other potential issues. When the shortfall of an income stream occurs, it puts a tremendous strain on family members. Someone has to make up the difference in the income shortfall or pay the additional LTC costs out of pocket. A lot of times, it ends up being the children. Or family members try to become the care provider to save on LTC costs. That can cause an additional loss of income for the caregiving family member, and it can cause physical and emotional strain on that person that leads him or her to needing care down the road. Another potential consequence is having to go on Medicaid when there is a shortfall of LTC benefits. Now, when you go on Medicaid, you are letting the government take control of the type of care you're receiving. I don't know about you, but I want the government involved in my life as little as possible. With Medicaid, the government will dictate what facilities you could be in. The facility they choose could mean being in one hours away from family. It could also mean that if both spouses are in care, that they're in different facilities. Lastly, with Medicaid, the quality of care goes down. On average, for a private paid or insurance paid bed, there's about 1 nurse for every 4 beds. For a Medicaid paid bed, there's about 1 nurse for every 16 beds. So quality of care is a lot less than a Medicaid paid bed. One additional potential consequence of not protecting against the catastrophic LTC event is blowing up a legacy plan. A lot of affluent people have great legacy plans in mind. These can be completely destroyed by shortfalls in LTC protection. So we've talked about why a client needs you to show them lifetime benefits to protect against the catastrophic risk. Now let's talk about how it potentially impacts your income as an advisor. Our lifetime benefit rider is extremely important to agents that are money managers and get paid annually for assets under management or for marketers that work with money managers. We talk about the lifetime benefit rider protecting a client's retirement income and assets, but don't forget, as a money manager, it protects your income as well. If you're a money manager and putting clients in a wrap or a managed money account where you're earning a 1% commission or trail each year, your income is at risk. As we talked about earlier, 70% of clients ages 65 or older will need long-term care in some manner. If you have 500 clients age 65 or older in wrap accounts and 350 of them come to you to start spending down their assets for LTC, what does that do to your income? Not their income, but your income as an advisor. It would crush it. By having an infinite pool for LTC set up for your clients to go to, you put a theoretical fence around their assets to protect that from happening. Your number one competitor as a money manager isn't the agent down the street. It's the LTC facilities in your area. They'll gladly take the assets out from under your management, and they won't even have to advertise to do it. So now I just want to give you a brief synopsis on how we do lifetime benefits with our whole life and annuity-based LTC solutions to protect against the catastrophic risk. So there's always going to be a base policy. It could be a life policy or an annuity, and there's tons of ways that we could fund it. We could use the lump sums from cash, non-qualified annuities, qualified money, cash value life insurance, or recurring premiums. The beauty of this is that a client can fund this with any kind of assets that they want. If the client needs long-term care, the client would spend down this base policy first. Once the base policy has been exhausted, there's a continuation of benefits rider that kicks in and continues the LTC benefits for the rest of the client's life, as long as there is a need for care. The rider portion of the contract can also be funded with an asset or via annual premiums. Conceptually, think of this base policy as a deductible that the client has made with his or her own asset. Like any other insurance, the deductible has to be met or spent down first. Then think of the rider as your catastrophic insurance coverage, or as an income rider for a specific retirement expense that can be turned on if necessary. So at the end of the day, you've created a high deductible catastrophic LTC insurance policy. And remember, high deductible insurance is what affluent people buy. Affluent people aren't worried about short-term care or small risk. They're worried about long-term care or major risk. Think about other types of insurance that affluent people buy, such as medical insurance. While the average person on the street might have a $500 or $1,000, or $1,500 deductible for their medical insurance, affluent people prefer things like $2,500, $3,500, or even $5,000 or $10,000 deductibles for their medical insurance. The reason is that the affluent can easily afford to cover a medical event such as a minor ER visit, but they wouldn't want to cover the cost of cancer treatment. By taking on more of the smaller risk, they can get their catastrophic insurance at a much more affordable rate. So what we've done is we've just taken this high deductible catastrophic way of purchasing insurance and tied it to long-term care. Because you spend down the life or annuity policy first, it acts like a deductible to the continuation of benefits rider, which is the catastrophic risk coverage. So kind of think of like your life or annuity policy as your health savings account, where you spend it down first as a deductible before your COB rider kicks in for your catastrophic long-term care insurance. This allows us to offer the COB rider, or the catastrophic long-term care insurance coverage, at about 50 to 70% more affordable rate than a standalone traditional LTC insurance policy. So when someone asks you what OneAmerica does for LTC, remember, OneAmerica is a high deductible, catastrophic long-term care insurance policy. So that's it for today's webinar. If you have any questions, please feel free to reach out to your OneAmerica internal wholesaler, your marketer, or your back office support for more details. If you had an issue and need help getting any of the slides, please reach out to us at caresolutionstraining@OneAmerica.com. And lastly, we'll be reaching out to those that had chat questions to answer them today and early next week. Thanks, everyone. Have a great weekend.